Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Joining us at the MarketSite studio, we have Chris Englebert, Founding Partner and Chief Investment Officer with Englebert Investment Advisers. And the question I am asking him is, should I stay or should I go? Chris, I am sure many clients are asking their advisors that. So let's start with that question there. What are retail clients thinking? You know, it's been a choppy year, and you kind of know what that mentality is. It's mentally hard to stay long in this market.
Yes, Jill, and I came up with this idea for this segment, should I stay or should I go? And I don't mean the favorite song by The Clash from the early 80s, but really what clients are doing and people that have advisors, they're saying to themselves, well, you know, do I change my investment strategy? I mean, the stock market's down, but this year the bond market was down too, and that caught a lot of people off guard. And so they're saying, you know, is my strategy the wrong strategy? A lot of people mistakenly feel like they just got to do something, and we're trying to counsel them that one bad year doesn't make a trend, especially in the bond market where a lot of people got caught off sides with the aggressive Fed hikes. And again, you know, people feel like they need to do something, and we're trying to counsel them, let's sit back, let's take a breath, let's really study what the markets are doing and what's going to happen in 2023.
Right, and I think the important thing to remember in addition to managing the investments is registered investment advisors, they need to be proactive and they need to have these conversations, and that's really how you earn your advisor chops, when you have these conversations in tough markets, because there are a generation or two of advisors out there who have not really had to have these difficult conversations in a market with prolonged volatility. So explain to me, as someone who's been doing this for decades, why it's so important to be proactive.
Well, we reach out all the time. So we do videos on a weekly basis. I have an app for the smartphone. You know, when we do these videos, we push them out to our current clients. Interestingly enough, a lot of those clients forward them to, you know, their friends. And we're always talking about the investment markets, what the strategies are doing. And the other thing that we do is contact. What I mean by that is we are always reaching out to clients. Hey, do you want to do a phone call? You know, do you want to come into our office? Now, obviously, everything's opened up. But what's the really neat thing is there's always interesting things that take away, you know, when you go through a tough time. And now we're still doing a lot of Zoom calls because it's very convenient. But again, the point is we don't hide in a bunker. We make sure we come out and talk to our clients. And we talk to other people because we're getting other people calling us up going, my advisor hasn't called me in the last year, which I actually believe is a big breach of fiduciary etiquette. You got to talk to your clients, whether it's the good, the bad, or the ugly. You got to be talking to them all the time.
So how do you manage it when someone calls you up? I can't take it. The market's just moving way too fast. What do I do? I mean, you know, with your experience that over the long term, it's going to make sense. But what do you do when you have someone you got to talk them off the ledge?
Yeah, I mean, sometimes you got to assess the client's mental state. And I mean, if they're in a situation, like I remember years ago, I had a client come in and he was just distraught. And you know, sometimes it tips over to a point where you can show all the long-term charts, etc. But I always tell them, if you are getting out, we need to have a game plan to get back in. And we sit down and we actually talk about what's that game plan to get back into the markets. Right now, there's this incredible pervasive negativity going on in the markets. You probably saw the same information I did. The AAII numbers, the American Association of Institutional Investors, 37 weeks of negative numbers on the AAII numbers. So there's a lot of negativity out there, and we keep trying to tell people the surprise is on the upside. We've had a really good October, we've had a really good November. Let's see what happens between now and the end of the year. But again, a lot of the things that, you know, people were very concerned about coming into 2022 are suddenly changing, and that really changes the dynamic longer term. So again, if somebody is just at their psychological wit's end, you know, you got to do something, you know, for them. But most people, once you start explaining to them, here's what's happening in the economy, here's what's going on out there, you know, they realize that instead of looking at it in the real short term, literally hour to hour, day to day, they understand that, you know, wow, you know, 6 years, you know, from now, this is going to be a blip on the chart, you know, from when you look at, you know, the investment strategy.
Well, I mean, look at the blip on the chart from the COVID sell-off, right? I mean,
yeah.
That was a generational return that you saw there. And I also think a good segue for us to get into the charts, because it does feel like there is demand. I mean, we saw what the market did yesterday after Powell's, you know, comments, right? So let's take a look at the S&P 500, our first chart here, and you know, what did you see for the month?
Yeah, so we have had two good back-to-back months. Again, there might be some FOMO going in the end of the year, fear of missing out. there's a lot of institutional investors with a lot of cash. You know, I'm big on Twitter all the time, and if you just survey the Twitter world, you know, negative or bumping up against the trend line. Yesterday, we broke through the 200-day moving average. Everybody's like, that's a short, the 200-day moving average. We not only broke through it, we sliced through it like a knife, hot knife through butter. And so, you know, people are beginning to realize that maybe we're not going into this bone-crushing recession. That's something we've been saying for the last 3 to 4 months, is that the market's pricing in a moderate to severe recession out there, and it's really scaring a lot of investors away. I keep taking the other side of the trade saying, what happens if that doesn't? I mean, you know, you had a white-hot economy when we reopened up, and you had a lot of inflation. What happens if we go from white-hot to moderate, which is my view going into 2023?
Let's talk about the NASDAQ 100 here. It's interesting because we're starting to see some cutbacks in terms of jobs with these tech companies. There probably was a little bit of overhiring during the pandemic. Are you starting to find some value at this point?
Yeah, there is. I mean, I believe that we've actually saw the peak in February 2021. If you go back and look at a lot of the charts of the COVID names, et cetera, they peaked, they rolled over. Many of these companies have been slammed 80, 90%. And this is just like, and maybe this is the, you know, the reason why somebody wants a seasoned advisor. I remember the tech bubble like it was yesterday, and out of the rubble of the tech bubble, you found companies that were 5, 10, 20 times returns over the next 10 years. And I think investors really need to sift through that rubble and see who are going to be the winners and losers. And you're exactly right. Was there froth in it? Was there a lot of you know, magical, you know, eyeballs on clicks type of thing? Absolutely. But there's a lot of companies now that are doing 3, 4, or 5 times the business. You know, for example, enterprise software. A lot of babies have been thrown out with the bathwater there. There's some value there, and I think investors have to really take a look.
I mean, this valuation reset really could have been a gift here when you think about it at the end of the day. What about oil? That's been up and down.
Yeah, so we've been on this train for a while. We've been saying that oil could end up revisiting, you know, where it started the year, it ends the year. It actually did trade exactly back to where it started the year, around the mid-70s. You know, again, we keep track of the rig count. People don't realize that Texas, Oklahoma, North and South Dakota, we've gone from about 200 oil rigs and natural gas rigs pumping to over 640 oil rigs pumping. So again, you know, people are trying to say, well, oil's coming down because we're going into a recession. I'm saying that oil and a lot of these natural gas products are coming down because there's a ton of supply out there, which bodes well for the consumer longer term, because all of these inputs that have caused these hot inflation numbers are beginning to roll over. Oil was the main one that rolled over, but all of the petro products that every time people get something made from an oil product, those prices are coming down too. So again, inflation is cooling. It may not be back down to less than 2%, but it's not going to be 8% like we saw it earlier this summer.
You know, before we get to the 10-year, I want to talk about inflation for a moment, because we're seeing the data come in. I think 7.6% was the last reading, but when I go to the store, we were talking about it on the desk this morning, I feel like clothes and food are way more expensive than that 7.6% reading.
Yeah, and so, you know, inflation and all the components that go into inflation is a very lumpy number. You know, you had housing prices driving it, you had you had oil prices driving it. Well, now you're kind of seeing some of the back end of inflation, like you say, and we still believe that some of those numbers are going to moderate in the near future, probably by the Q1 of 2023.
Well, let's hope so, because I had a guest on the show the other day where Thanksgiving spending for your meal was 14% higher this year over last year, and you know, you're starting to feel that. Anyway, let's wrap up with our last chart here at the 10-year.
Yeah, let me talk about bonds for a second, because like I said when we started earlier, a lot of clients, a lot of investors, they added bonds to their portfolio to give them some protection against stocks. That didn't happen this year. You saw bonds go down as much as the stock market did, and a lot of investors like, what do we do? I keep saying to people, as long as it's paying you your income, you want to keep that bond portfolio. Now, we've been doing some swaps for some tax loss selling, but we're going right back to longer duration bonds, because if we're wrong and we do have a recession later in 2023, 2024, you could see interest rates come down dramatically. Many of these bond funds that have lost 14, 15% could gain 12, 13, 14, 15%. But the other thing, Jill, that a lot of people don't realize is that on the short end, there's a lot of bargains out there. What I mean by bargains is we're seeing bank CD rates 4%, 4.5%. I haven't seen that in 8, 9 years. So, you know, investors are sitting there going, gee, I have an alternative, especially older investors. We think that they got to take advantage of it. The other point that I want to make is that these bond funds usually have like what the big phrase is average duration. It's just a fancy term like how long are the bonds in the bond fund. So if your average duration is 5 years, what happens is that every year that ticks by, you're replacing 20% of those bonds with higher coupons, another 20% with higher coupons. So our forecast is that as far as interest rates go, we don't see a lot on the upside, a lot on the downside. I can make the case that the next couple of years, bond funds return your coupon 3, 4, 5% plus 50 basis points. So it'll give investors some other place to hide out and again, try to control the volatility of their portfolio.
We spoke about this when you were on with me in November, that some people, their mortgages, their rates are actually lower than what you're getting in savings accounts. There's probably a handful of times that that's happened over the course of market history.
Yeah, and that's a arbitrage all the time. I mean, I had a retired gentleman call me the other day, and he's like, hey, I want to pay off my mortgage. I'm like, what is it? He's like, oh, I have $50,000 left at 2.75%. I'm like, you're never paying that off because you're never going to see that kind of rate again. And I said, do you understand you can take your investable assets and go out there and do that arbitrage 4, 5, 6, 7% and make a differential is what you can end up doing. That leads me into my last comment about the housing market. So again, when interest rates go up, this summer everybody's saying the housing market's going to collapse. I think what happened with higher interest rates and higher mortgage rates is we took a lot of froth out of the housing market, and so we're getting housing market back to a more realistic level. However, if you look at the demand and the supply of housing, I can't make the case that there's going to be a big collapse in housing. If anything, prices stay rather moderate because you've got a lot of people in their 30s and 40s that are looking to buy their first home or move up to another home. So when you hear a lot of people saying, oh, there's going to be a housing collapse and that's going to really, bring the U.S. economy down, we just don't see it.
And to wrap up here, when you think about your outlook for 2023, it sounds like this is really going to be the year of active management. Just throwing them in passive investments is not going to work like it might have done for the past 15 years.
Yeah, we've been on the theme the last couple of months that we are entering a structurally fair market. And what I mean by that, instead of a market that just takes off and goes up to the right, you've got a market that's going to rally 20, 25%, maybe decline 20, 25%. And the reason being is that we're in this mode of changing from a low inflationary, low interest rate environment to a higher inflationary, higher interest rate environment. So what ends up happening with equities is that, wow, earnings are really good like they were third quarter. Market takes off. First quarter of next year, maybe you have some hiccups, market comes back. So you're absolutely right. We think that this is probably the next 5 to 7 years is going to be the era of active management, not only for advisors, but for money managers.
And I keep saying one last comment, but you keep bringing up these great points. But those are normal markets. What we saw over the past 10 years, with the exception of 2022, it's not normal just to see it go one way. That's why we have averages your 8 to 10% return each year. And I think we just have to regauge our thinking as investors, as advisors, as traders, as money managers. It's not as easy as it looked.
No, I agree wholeheartedly. Again, when I first got into the business back in the 80s, that's exactly what was going on. The first part of the 80s were this rally, decline, and then all of a sudden in the mid-1980s, as interest rates came down, corporations did a lot of mergers and acquisitions, the market really accelerated. I think longer term, that's exactly what we're going to be going through, where we're going to have this period of adjustment over the next possibly 2, 3, 4 years. So a lot of investors that are going to set it and forget it, you can't set it and forget it anymore. You've got to make some tactical decisions where, hey, do I increase my bond weighting because rates are higher, market's down? Do I increase my equity weighting, or do I take some money off the table? I think we're getting back to that style, and a lot of people are not prepared for it, and we're hoping that they understand, that you need to have a strategy, and that's what we do.
All right, appreciate the insight as always, Chris. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.